It's time to have an important conversation about your retirement. I've heard retirees tell me for many years that they're worried about their retirement income or their retirement investments during their retirement years. And those are justified concerns that need to be addressed. But I'm at the point of being tired of hearing that most retirees are not focused on the most important thing to be worried about in retirement, and that's taxes. Folks, the three most important things when it comes to thinking about retirement is not only where is the income going to come from, it's not only what is the portfolio going to be invested in, but the question needs to be asked, how am I going to manage my taxes during my retirement years? Because after all, taxes will be your number one largest expense during retirement. Hi, folks. Thanks for joining me here today in another in our series of What Your Advisor Isn't Telling You videos. My name is Greg Parker with Engrave Wealth Partners, and I want to talk about a topic today that has become extremely important, not only because of the number of people that have recently retired and are focused on retirement investing, but specifically because we see what's coming in this country in terms of taxes and how it's going to impact you in retirement. If you've never heard this before, prepare to be shocked, because when you think about retirement, you need to be thinking about taxes. How do I know this? We've looked at investments, we've looked at income, we've talked to retirees for years. What we continually see is the surprise that most retirees face when they start to understand what they're going to be paying in terms of taxes. It creates a real problem. And when you think about it, it's a problem by design when it comes to retirement. What do I mean by that? Well, it's the way retirement was built. If you think about it, during your working years, there were probably 3, maybe 4 different types of retirement savings that you had access to. Perhaps you worked for a company that provided a pension, a 401k savings plan. Maybe you even had restricted stock units or supplemental pension offerings. All that matters now is that once you've retired and those assets are distributed, we start to see how a tax problem could come about. For example, if you had access to a pension, maybe you chose to take that pension as a lump sum distribution and rolled it over into a personal IRA. If not, you chose the annuity, where you're receiving a set monthly income that is directly wired to your bank account as if you were still working, and that annuity payment is coming to you in the form of ordinary income. When we look at a 401k savings plan, there were multiple options at retirement. Many of you took the plan and rolled the entire amount into an IRA. Maybe you had some intelligence to be able to look at whether or not you needed to use NUA, whether that came from a professional advisor, a CPA, or maybe you studied up on this. Maybe you even knew that your after-tax contributions in the 401k could be rolled over into an IRA. Folks, if none of these things sound familiar, I'm going to encourage you to go back, watch a video we created called Retirement is Rigged Against You. It's a video that explains where all of these things come from and what they're used for. The last 2 plans, you need to know that restricted stock and supplemental pension are generally taxed at the time of vesting. And for most of you, vesting occurred when you retired. Why does it matter when you look at where these accounts went when you were working and once you retired? It matters because of how these accounts are going to be treated in terms of creating your retirement income. The natural question you should be asking is, where's the most opportune place for me to derive my retirement income? Should I be taking it from my IRA? Should I be taking it from an after-tax individual or joint brokerage account? Or should I be taking it from my Roth IRA? Folks, the way to answer that question is to fully understand the tax implications of each of them. If you're living 100% off of your IRA in the form of IRA distributions, you need to know that 100% of those distributions are treated as ordinary income. Ordinary income, there's that phrase again. What does that mean? Well, it doesn't mean much unless you work for the IRS, but if you work for the IRS, the words ordinary income flash $signs in your eyes. Why? Because ordinary income is the same thing as salary or wages. In other words, it's the income that is applied to the marginal bracket system. The more you earn, the more taxes you pay. To the IRS, if you're taking money out of an IRA you're paying taxes just as if you were still working. Now, what's the difference? What if I took my retirement income out of my after-tax individual brokerage account? Well, that's something that we call tax-preferred income. Now, what does tax-preferred mean? Well, it simply means that the taxes you pay on that income is largely going to depend upon how you invested it. For example, if you have an after-tax brokerage account that's invested 100% in municipal bonds, or tax-free bonds, as we like to call them, you can live off of the interest that is 100% tax-free. You pay no taxes at all. Now, why don't most people do that? Well, simply put, the interest off of municipal bonds is a very low number. Most retirees do not have enough money in their after-tax brokerage account to invest in the number of municipal bonds that it would take to generate a tax-free retirement income. So what else can we do? Well, many times we will focus on using tax-preferred vehicles, things like qualified dividends off of stocks or long-term capital gains from the sales of investments. Folks, long-term capital gains and qualified dividends enjoy special tax treatment. Under the current tax law, qualified dividends and long-term capital gains are generally taxed at your ordinary bracket with a maximum of 15%, unless you're in the absolute highest marginal bracket, in which case it's 20%. Folks, either way, that still represents a significant tax savings for you. That's a way to generate some retirement income without having to pay 100% ordinary income rates. Finally, what about the Roth IRA? This is a relatively new vehicle for most people that are retired today, but what you need to know about the Roth IRA is the opportunity to generate tax-free income. Now, there's some caveats to that tax-free income you need to know about, but the key question is, why don't most people just live off of their Roth IRA? Well, the answer is because the Roth IRA is a relatively new vehicle. Most of us don't have enough money set aside in the Roth IRA in order to generate enough tax-free income for retirement. So what ends up happening is you look back at the three boxes and you see that there are three different colors. The red IRA rollover is because that is the least tax-friendly source of retirement income. Folks, understand what I just said. Income taken from an IRA is the least tax-friendly form of retirement income. The after-tax brokerage account is marginally better because it depends upon how we invest, where the Roth IRA is blue because it is the tax-friendliest way to invest in retirement. Again, qualified income coming out of a Roth can be tax-free. Now, why the different size buckets? When I look at a red bucket versus a green bucket versus a blue bucket, you can't help but notice that the red bucket is oversized compared to the other two. Well, that is simply because when I meet with folks that are retiring in any industry from any company today, most of their retirement savings sits in some form of an IRA, which came from their pre-tax 401k or a pension lump sum. Folks, at the end of the day, we're stuck in a sense in generating retirement income that's tax efficient because the majority of our retirement savings sits in an IRA. What does that really mean? It means that any income we take is going to be taxed at a higher rate today. I understand that. But there's a bigger point you need to understand. Modern financial planning says, hey, most retirees are going to enjoy lower taxes for the first few years in retirement because they can live off of the after-tax brokerage account with qualified dividends or long-term capital gains, or even withdrawing principal. In other words, most financial advisors today are astute enough that they're wanting to help get you the income in the first few years of retirement without touching the IRA. Makes sense. You don't want to have to pay the taxes if you don't have to, but here's the problem. They're actually doing you a disservice by helping you lower your taxes in the first few years of retirement. Let me say that again. Your financial advisor is doing you a disservice if they are focused only on living off of after-tax savings and not touching the IRA. Why? IRAs have a very particular rule you need to know about. IRAs are subject to something known as RMDs, required minimum distributions. You see, the IRS says they've been allowing you to set aside money pre-tax in a 401k for all of those working years. They even allowed you to avoid the taxes when you rolled that money into an IRA. But the IRS says you're not going to avoid taxes forever. Beginning at age 72, everyone with an IRA or a 401k must begin withdrawals. The withdrawals are dictated by the IRS in terms of how much you must withdraw. It doesn't mean you have to spend the money, but you take it out of the IRA, generating an IRA distribution, meaning you're generating ordinary income. Folks, at age 72, you no longer get a choice. You're now required to take money out of the IRA, trigger the taxable income, report the taxes on next year's tax return, and pay the tax bill. For most of you, what that's going to look like is a steady stream of rising ordinary income, taxable income, beginning at age 72, and you're not even working anymore. This is a problem. If the blue line represents your income, the green line represents your taxes, that little jump there further down the line represents you turning age 72, where you are going to see a market increase in taxes due. That means if we are not touching the IRA in the early years of retirement, we're making a serious mistake. How do we solve this problem? We need to step back and we need to build out a personal retirement analysis that looks at your retirement life in the lens of your assets, looking at your retirement income needs and where that's going to come from, and the potential tax liabilities from each of these. Once we have an idea of what that looks like in year one, we need to hypothesize what it looks like year 2, year 3, year 4, and on throughout the rest of your retirement life. Generally, we take that out to age 95 for most people. By understanding what this looks like, we can start to see what your tax liability is going to be at age 72 so that we can then work backwards. And how do we work backwards to help minimize the tax liability at 72? We're going to focus very carefully on the whole idea of understanding what tax minimization is all about. We're going to start off by looking at the taxable brackets and understanding that in your base case scenario, maybe you're going to recognize a base level of income, whether that's from Social Security, maybe you're doing some consulting work, maybe you've just got other income sources generating, in this example, 60, 70, maybe even $80,000 of annual taxable income. What we want to ask is a hypothetical question of what if we stepped in to do some tax planning where we took not just your base taxable income, but we executed what is known as a Roth conversion. Now, if you're not familiar with Roth conversions, we need to get familiar very quickly. And I have an entirely different video focusing on what is a Roth conversion that you can reference. But a Roth conversion allows us to effectively transfer money from an IRA into a Roth IRA in any given amount in any year. You do not have to meet a specific qualification for this. You can simply direct your brokerage firm to move investments from an IRA into a Roth IRA in any given amount in any given year. Why would you not move 100% of an IRA into a Roth IRA immediately at retirement? Well, because any Roth conversion you do is going to trigger ordinary income. Remember, any distribution from an IRA is counted as ordinary income, reportable to the IRS, and you have to pay taxes that year based on the marginal brackets. You do not want to do too big of a Roth conversion in one given year because it will trigger more in taxes. But it asks the question, what would the optimal Roth conversion look like? How much should we do? That's the type of scenario we're going to build. We're going to ask the question, should we do a Roth conversion that takes you up to the very limit of a 22% marginal bracket, a 24% marginal bracket, or a 32% marginal bracket? Which of those is most optimal for you? And folks, the way to look at that is to study the assets, the income, and the taxes each and every year for the rest of your life to know which one gives you the optimal outcome. In this particular example, we worked with a divorced individual who wanted to provide her sons with a decent inheritance, but still get the income she needed during retirement. We were able to show a solution that looked at optimizations for Roth conversions, working her into a 22% versus a 24% plan. And what we discovered is that by focusing on 24% maximum tax bracket Roth conversions each and every year before age 72, we were able to move the most money from her IRA to a Roth, generating less taxes in retirement coming from the RMDs. What that meant was her boys inherited a bigger estate than what they would have otherwise, but most important, they inherited a tax-efficient estate. The majority of her retirement savings that they inherited at her death are going to be in the form of a Roth IRA. Folks, Roth IRAs are wonderful assets to inherit, not only because the assets can transfer from one generation to the next, but with Roth IRAs, they pass down tax-free. Folks, this generated potentially $150,000 plus in lifetime tax savings for her by focusing on maximizing that 24% marginal bracket each year from retirement up until age 72. We've done the same thing for another couple with a little bit higher asset base that wanted to truly maximize the tax savings that they could generate by focusing on Roth conversions based on changing tax years. Folks, we know right now that there's a tax change coming. The Tax Cut and Jobs Act passed in 2018 had a built-in expiration date or sunset provision, meaning that today's marginal brackets expire in 2025, and that in January 2026, we go back to the 2017 marginal brackets with an inflation adjustment. What does that mean? It means that whatever plan we build today, we need to account for that change in tax structure beginning in 2026. This couple looked at how to maximize their tax savings based on where they sit today and how we can recognize and acknowledge when that tax change comes in 26 and how we can generate the most tax savings for them. Folks, if this is confusing, if you've never seen this before, I strongly encourage you to think about running a personal retirement analysis with Engrave Wealth. We've looked at this over and over again, and we realize it creates confusion and thus anxiety for a lot of retired investors. So we created a commission-free fiduciary planning process that's designed to help you minimize the taxes you're going to pay in retirement, focus on the income that you're going to need in retirement, even if you need a little bit more in the early years than you'll need in the later years, and how do we protect that portfolio during times of market stress. These are all part of our personal retirement analysis that answers basic questions like, does my portfolio have too much risk? Or how much am I really paying in commissions and fees? And what about these so-called Roth conversions? And what can they do for me? Or what about my RMD tax liabilities? Folks, all of that can be optimized for you free of charge. This is a personal retirement analysis that we've built that is designed to give answers to your basic questions by focusing on your current tax year return as well as your current investment accounts. Folks, with that information, we will confidentially build out this plan and agree to meet with you on Zoom or in our office to present the plan and share with you how you can really optimize tax managed income in retirement. If you'd like to engage with us in that plan, we encourage you to go to the website at engravewealth.com, click that Start Your Free Retirement Analysis button, and give us some basic information so that we can reach out to you and customize that plan and schedule that time to visit with you. Folks, these are big questions, and these are important times to ask these questions. Taxes are going to continue to be a bigger and bigger problem in retirement. If you've not addressed these needs now with your advisor, it's time to think a little different and talk about how to build that plan. Folks, we look forward to talking to you. We look forward to delivering your plan, and we hope to talk very soon.